Good morning, everybody. Welcome to Syndication Attorney's free monthly podcast, where we talk about topics of interest to real estate syndicators with the opportunity for live questions and answers at the end of the call. I'm attorney Kim Lisa Taylor. Before we get started, please note that all of our calls will be recorded and may be used for future promotion, posted on our website, or broadcast in a podcast available to the public. If you don't wish to have your voice recorded, please schedule a one-on-one consultation instead of asking questions during the live call. But if you use the question and answer function, then we'll just read the question so your voice doesn't have to be recorded, and we'll just identify you by first name. So if that's okay, go ahead, ask questions away. The information discussed during this free podcast is of a general educational nature and should not be construed as legal advice or tax advice. This will be an audio only presentation unless you're here live today. So our topic today, just one moment, I'll get to it, is build to rent strategies for syndicators with our special guest, Dave Seymour. Hey, Dave. So Dave, kind of a celebrity.
Hey, Kim Lisa Taylor.
Yeah. So Dave is a bit of a celebrity. Maybe he's the most famous person that we've had on our show. So, well, besides me, of course, right?
Of course.
He's got a television audience. So that's a completely different audience than we appeal to. So Dave, tell us about your background and your show and stuff, what you do.
Sure. I'd like to look up the definition of a bit of a celebrity. That's like you're either not quite there yet, you're kind of cool, you were cool, you're not so cool anymore. I'm in the bit of a celebrity classification. So, I'm not Damon John from Shark Tank, but I'm not Dog the Bounty Hunter. I'm somewhere in the middle. How's that for an opening line?
I love it.
First of all, thanks for letting me participate. I love to do this stuff. I love to, just share whatever knowledge is out there in the marketplace that we see going on. I am Dave Seymour. I'm the CEO of Freedom Venture Investments. We're a private equity investment company based up in Boston and Fort Myers, Florida. Briefly, I wasn't raised in investment world. I wasn't raised in construction. I'm an immigrant to the United States of America. And I came over in '86 from England. My family background is very blue collar, kind of bring that blue collar attitude into this white collar world of commercial real estate finance today. But as you alluded, I was famous once for a little while. We had a TV show called Flipping Boston. It aired on the A&E Network for about 3.5, 4 years. Was exciting. I mean, it was fun. We could do another show all about the truth of reality TV and house flipping shows another time. But, it was the real magic of being able to do that. They followed us during 2010, 11, 12, 13, 14, as we were coming out of the 2008 crash. And it was blessed in the sense of it gave us expert status. 1 minute I was a firefighter in Lynn, Massachusetts. 1 minute I'm sitting in the firehouse. The next minute I'm sitting on Squawk Box with Joe and Becky and the rest of those guys, So, it created some momentum in my business. And then we've transitioned out of that into what we're doing today. So I'm a somewhat cool ex-celebrity who's doing big stuff now in a different sandbox, but we feel an appropriate sandbox going forward.
Probably making a lot more money now than you were then, right?
Yeah, there's no money in reality TV unless you're Kim Kardashian, and my kadunk doesn't pass the Kim Kardashian test, so I'm not making $1 million. Not for that.
Well, I have a saying about the legal field. There's no old syndication attorneys. They all turn into syndicators. We watch our clients get wealthy, and we're like, wait a minute, I'm on the wrong side of this transaction.
Yeah,
just need to move over.
Yeah. No, I'm with you. Yeah.
So I haven't made that transition yet, but definitely it's always out there as a consideration. So I do some investing in some of my clients' deals, but all right, well, good. We are so excited that you're here today, and we just want to pick your brain about this whole build to rent strategy, because I don't think this is something that a lot of syndicators are learning how to do the value add and, buy existing, make it better, increase the rents, increase the NOI, hold it for a little while and
Sure.
sell it. That seems to be
Sure.
the normal syndication model. But let's talk about build to rent. So what is it?
Yeah, it's kind of I would say a new asset class in the sense of it's got a lot of traction during the COVID period, and now even more traction post COVID. With the massive amounts of capital that came into the marketplace, we saw the compression of cap rates in existing structures. It's very hard to syndicate a sub 3 cap deal without making up imaginary rent increases of 5 to 10% a year, but your expenses stay at 2% a year. And there's a lot of pro formas out there, right? Let's just be honest, that are floating around with that BS attached to them. So for us, we looked at the landscape as we were going through the COVID scenario and began to see what we believe to be opportunities in pockets and markets throughout the US. And then we dug in, we did our due diligence. And without getting overly deep into all of the analysis, it's really the fundamentals of supply and demand. Which markets in the US are so undersupplied for rental housing that there's an opportunity to go in there and, as it says, build for rent. So when we start looking at I'll take Cape Coral, for example. Cape Coral, Florida, we're heavily invested in that marketplace. City of Cape Coral pulled down a study a few years back to find out what their supply side looked like for their demand side for rental housing. And they projected out to 2027 that they would be approximately 10,500 units undersupplied with the current amount of units coming online. Now, those can be built for rent, as in let's build a new apartment complex, which we're in the middle of doing right now in Cape Coral, but also build for rent single family communities. And that's the sexy button, if you will, in the build for rent space. Being able to find plots of land that will allow for multiple single family homes, but in a rental community. And what it's doing is I'll give you an example. Blackstone just allocated $25 billion for commercial real estate investments, a big portion of which is in the build for rent community to hedge against the current inflation status. Like if you just keep your ear to the ground and you start to pay attention to what the big boys are doing and where they're allocating capital, we got a saying at our company, we just want the crumbs that the big boys leave behind. But as long as you've got the infrastructure to execute on this stuff. So what's exciting about it is the supply and demand imbalance. One was the migration into the Florida market where we are. You see it in the California market down to AZ, big influx. California market down into Texas. This influx of human beings, this movement of people creates that demand side, and the supply side isn't there to sustain it. So it screams for housing. But the challenge is a lot of people don't want the typical old single family stock that's been rehabbed 20 times over the past 30 years, right? You've still got the pee stains in the bedroom from the cat that lived there 25 years ago. People don't want that. They want quality assets, but they want to be able to rent single family homes. So that rental base is the retirees. It's now the urban professionals who can't afford the single family home. It's the millennials. And in the Florida market, with its massive influx of retirees, that retirement community statistically is pulling down 3 to 4 support positions or jobs for every one retiree. So that's especially obviously in the healthcare community for retirees, but also in home care and also in service oriented positions. So that's really what it is. It's single family homes that are for renters by choice. That's really one of the catchphrases that any of your community could type in and see what's going on. Renters by choice, build for rent, or BTR, BFR, the two classifications. And it's the one thing that it doesn't have right now. It doesn't have the exit strategy numbers to support its valuation on the way in because it's so new. If you build, a 130 unit complex, we have enough data to know what the exit strategy on a 130 unit complex should or could look like in any market. But we don't have that data yet because it's a newer asset class. But basically, and I'll sum it up with this, our cost or build to cost percentages are coming in anywhere between 6.5% and 7%. So if my loan to cost or build to cost is coming in at that number, that's still beating existing cap rates in the marketplace for other multifamily assets. So I can bring a brand new quality asset online with a better return profile than some of the existing structures. So I hope that was clear enough. I don't always think nor talk in a straight line, but that's what BFR is.
I'm taking notes, and I hope everybody else on the call is taking notes. This is some good stuff. So I do want to follow up on a couple of things that you said, though. So it sounds like you're looking for markets that are undersupplied for multifamily housing. Where would that data come from?
We work with a couple of different data suppliers. I mean, you can go to the free online sites. What is it? Citydata.com, stuff like that. I'll be able to help you out. We like to pay for our services. So we work with a company called Yardi, Y-A-R-D-I Matrix. They're affordable, but we just pulled down that data. Look, for us, Kim, and I can only speak from my experience, right? Freedom Venture Investments, we invest only at this point in the Florida market. And my team has over 25 years on the ground in that market. So it's easy for us to pull down city data, to pull down the Yardi matrix data that we need. And that's how we cross-reference that, you know, on the supply and demand side. Okay. But look, I can do big picture, right? Macro, micro markets. The macro markets are easy to pick. Florida, Texas, Carolinas, Arizona, which interestingly, most of them are also, red or blue states. And we'll just leave it at that. We won't have a political discussion, but sure. You know, we like to do business where we're welcomed. Yes,
yes. That's absolutely true. So it sounds like so the apartment complex you're building, like how many units is that?
The one we're in right now is a 106 unit build. It consists of 5 buildings. Equity raise on that is coming in just shy of 5 million. The financing is interesting right now. So I don't just go with one potential lender. I'll stroke the checks for due diligence for a couple of different lenders to be able to, to get to the full construction loan on it. But it's all in process, so it works quite nicely. I mean, the system has been established, and then it's just a case of implementing.
I've had 2 clients recently. One that was buying an existing project that said, yeah, our lender just dropped out. And another one who was doing a 255 unit multifamily property out in the Pacific Northwest, who said that their lender's ready to go, but they had somebody else who was going to do the private equity and they dropped out. And, so it's just people are getting skittish right now. So your idea of paying the money to get 2 lenders to do due diligence on you is probably very sound, because it's likely that one of them is going to close, even though it might cost you $50,000 or $60,000 to get them to that far, right? But that might be.
I'm paying almost $500,000 for a balance sheet and a credit enhancer on this particular deal, because it makes sense for us to do that. It goes back to the fundamentals, Kim, that no skinny deals are going to get through in this market. The old adage was, we make our money on the buy side, we realize the profits at time of refinance or sale. It's the same thing no matter what scale of investment it is. So don't buy any skinny deals. Make sure the numbers make sense on the way in, right?
So these single family communities that you're doing, like, is there a preferred number of units that you look for? I mean, would you do a 3-unit property, or are you looking for 30, or what's your sweet spot?
Yeah, that's a great question. The ideal is anywhere between 75 to maybe 250. So what you need for that is obviously a sizable piece of land that's in the demand market where you're doing business. And then is it already zoned for multifamily? Does that community understand what you're going to do, even though it's under a multifamily zoning process? And if you can find that piece of property, then it's a case of how many units can you fit on there. So that's when you need to start dropping the money for your engineering, your architectural, to get through the entitlement phase. But these particular projects are designed to be what's called zero lot lines. So there's they're closer together. It's the same as multifamily, more bedrooms, right? More doors, more value. So we want to maximize the dirt infrastructure to get to vertical construction on these. So we want to be able to get as many single family homes on there as is possible. The other thing to take into consideration is what that specific zip code or neighborhood is looking for amenities, right? If you're in the Florida market and you drive by some of these condo complexes, for example, they've got the guy at the gate with the hat, with the security badge, and, there might be a couple of golf courses on the site, blah, 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 and the swimming pools and the clubhouse. We're not necessarily going down that road because the economics don't make sense for us. So we like a lot of land or a plot of land that's multifamily, already multifamily zoned, that we can go to that city with a good business plan. The city likes what we have to offer. We get in there with our engineers to make sure that we can get the number of units on there to maximize the investors' potential and our potential as the operators. And once we can tick all of those boxes, then we've got to get into some kind of contractual relationship with the seller. And that can be interesting. We can pay anywhere from $15,000 a door to $70,000 a door, just on the land costs as we go into these projects. So that's kind of like the big picture idea of the process.
Well, that's all really helpful. And so when you're doing this, are you using your own money let's talk about like just kind of the financing, because we talk about raising private money legally. So when do you raise money, and do you do it in phases? Do you raise money for the land acquisition and the entitlement and then do another phase for the construction, or how do you do that?
Yeah, that's also a great question. And it's interesting. We have a lot of optionality at this point. So the first thing capital is obviously at a higher risk profile than the last thing capital, right? Everybody feels warm and fuzzy if they can see the building and they see tenants, and it just makes sense up here for them. Our investors that come in at what we call the co-GP level are in a preferred position with us, and they will come in for land acquisition up until entitlement. Once we've got that piece of our PPM in place, then we can get into the LP economics and the LP raise. And that's where we are right now with the 106 unit build. So at that point, their economics or their shares are a different class of shares in the PPM structure. Once we've allocated and taken care of the equity position, then we go into the debt, obviously. And usually the debt is coming in closer to the start of the vertical construction. So I may have a combination of co-GP capital coming in at a higher risk profile, LP capital coming in once I've got commencement, a notice to commence. That LP capital immediately goes into the dirt, is what we call it. And don't think we're burying your money, but we're moving dirt, we're building slabs, we're pulling utilities, we're going through grading and all of those processes. So some of the LP capital will go in there, and then a portion of the LP capital will start the vertical construction as we get into putting the construction loan in place.
Okay, that's I think super helpful for people to understand, and I just want to explore the concept of the co-GP status. Because you could just put people in a separate class by themselves as part of the LP class and give them a better return. But my guess is that one of the reasons that you're putting them in co-GP is so that you help get your 10% into the deal that the lender's requiring. Is that?
Yeah, great. Yeah, great point. Yeah, so that co-GP position, obviously it looks good to the lenders later on down the line. Everybody says, how much capital do you have in? So, we'll do a pari passu in a co-GP position so that we obviously have skin in the game as well. So yeah, that's the answer to that. Yes. We have more GP money in the deal, but it's a pari passu with our co-GPs most of the time. All right. There are no definites. Each deal is has fluidity to it.
For anyone who's wondering what pari passu means, it means the distributions happen in order of preference. So you usually do have a preferred class that gets paid first, and then you go to the next class, they get paid, and on down the line. That's pari passu versus the other concept of pro rata. Whatever money you have, you just kind of give whatever percentage of that to every class, all concurrent. So you're giving your.
I had to look that up, by the way, Kim. I had to look that up when I started. Guys kept on throwing pari passu around. I'm like, what the hell does that mean? It's a whole new language out here.
There's always been a time when we've had to learn, like, hey, I was at an event years and years ago where it's like, what's a security? Okay, so I didn't know it then either. So,
yeah, right.
We've all got to learn, and we're all starting in a different place on the road. So that's okay.
Sure.
That's all right. All right. So renters by choice. I actually know some people that are renters by choice. I have some family members that have chosen that route, against my judgment and against my advice. But, if you're like me, you probably have some people in your life that can't be helped, and you just have to love them anyway and try not to talk to them about business.
Sure. Sure. It's about attraction, I think, rather than promotion. You know what I mean? Let people see the results.
What you're doing, and they see, oh my gosh, you're doing really well doing this. Why aren't you doing this? And some people are just risk averse, right? They just don't want to take the risk of putting money in anybody else's hands, and for whatever.
I'm sorry, I have to take that bait. All right. So in this economy, right, you're talking about risk averse. I had a conversation with an incredibly intelligent guy. He's probably pulling down anywhere between 350, 400 a year salary, another 400 bonus, accredited times, 10, very, very smart. And he is incredibly risk adverse. And, he said to me, what's best case, worst case scenario? I said, look, this is a syndicated asset. You're an accredited investor. You're an intelligent human being. The SEC requires, and I'm telling you right now, you can lose every single dime that you invest in this deal. Okay. Do not invest a penny if it's a penny you cannot afford to lose. Now, if you and I were just hanging out, having a drink, shooting about a deal like this, I'd tell you worst case scenario is probably going to be just getting your principal back with no capital at all. Right. And he said to me, well, if that's the case, listen carefully. He said to me, if that's the case, then I'll just leave it in the bank. And I thought to myself, how with all of that intelligence, the people really not able to wrap their head around the fact that capital that sits still is capital, especially today, is dying every single day. It's like, I almost think of myself as like a superhero. Like I want to pull the cape open, yield man, out to save every static dollar in the economy, right? Get it out the door and make it go to work. So it's, risk aversion is an interesting concept if it's uneducated, right? It's uneducated. The educated investor knows the difference between, money sitting still and money going out the door and going to work. So I'm off my soapbox now. You can continue.
No, I completely concur with everything you said. It's again, it goes to the concept of people that can't be helped. They either aren't educated enough or have a skewed concept of what it means to build equity, right? And they don't understand that, and they think there's limitations, or there's, they're going to lose everything. And really, it would be even hard just to get into a situation where you could only give money back. The situations I think that cause that are people that have loans of short duration, right? That can't ride out whatever the market cycle is, right? So if we have a downturn, you ride it out long enough, you will get your money back and more. You just might have to wait a bit longer to do it. And if something happens in that interval that you have to get your money out of that deal, or you have to refinance and you can't because the market cycle is wrong, that's where you're going to lose. And so, the rule there is don't over leverage, and also make sure your loans have as long as possible maturity dates or extensions that can help you ride that out. Because in the last recession, the people that had those short duration loans that came due during the, when the market was depressed and they couldn't even sell the property for what the loan was worth, they're the ones that got in trouble, and so.
Sure. Yeah.
So there's ways to de-risk that or to minimize that risk as well. But it all, those decisions always affect returns, right? If you want to have a lower loan to value ratio, then your returns to your investors are gonna be lower, but maybe that's what your investors want. All right, so we kind of talked about what the neighborhoods you're looking for. I guess let's just talk about like what kind of markets you're looking for. Are you looking for emerging markets, or certain community amenities within the area, or are you building way out in the country? What are you doing?
Yeah, look, it's all data driven, right? It's all data driven. Population, the average cost of a single family home, the average income for the specific market, demographic driven. I don't have all of that data at my fingertips, but we take all of that data into consideration, because that gives us a picture of whether it makes sense. Just because you could buy something for $1, it doesn't mean it's a good deal, right?
Right.
So do you have the supporting data? Do you have the population growth? Look, I'll say it again. We're undersupplied in Cape Coral, where we're doing quite a bit of business right now, to the tune of 10,000 units undersupplied at the current build ratio. We also like to focus on the median price units. Not these expansive condo conversion type units. There's a workforce housing challenge in the state of Florida, and I think in other parts of the country, and that's just speculative, but I'm sure Florida isn't an anomaly in that sense. So workforce housing, that those for support jobs or positions need somewhere to rent. They can't afford a single family home, but they can afford somewhere that's decent for rent. So, those are the markets that we focus on. Again, I don't need to come out of Florida right now. If you write me a check for $250 million, I'm pretty comfortable that I could deploy that in the next 8 months with the same yield profile that we've been working with our current structure. So, there's plenty of work to do in our market without us needing to go look elsewhere.
And just jumping back to the financing a little bit. So I assume that you're raising equity through some kind of a securities offering. Is that right?
506C Reg D, yep.
Okay, so you're using 506C, so you're able to advertise for accredited investors. Are you also using private equity? Somebody who's going to, some quasi-institutional lender, hedge fund.
Oh yeah. So they can come, they'll come in on a JV relationship. So we'll work a JV deal. You bring in an SPV. There's a couple of different structures that we've entertained and looked at. Yeah.
Or preferred equity. Okay.
We had a lot of non-accredited investors that were biting at the bit to participate with our company, and it was interesting because you want to help, right? It's like they're $20,000 short of accredited, and it's like, you can't come in, and they're like, why? Because the SEC says so. Come on, Dave, make an exception. No, I can't. I love you, but I can't. So what we were able to do was, and there's still the limited number of investors that can come in, but we also run almost a revolving expansion fund, which is a fixed income expansion fund that allows non-accredited investors to come in as well. So I have non-accredited investors that are with us that take the 10% monthly distributions on their principal, and then that capital is paid down by development fees and acquisition fees on our projects as we're going along. So they get to participate kind of through the back door, if you will, but it's still legal, honest, and ethical, and they understand exactly what they're investing in. So that's how we get to work with them.
Okay, so that's interesting. So they're not directly investing in the 506C offering because they couldn't unless that 506B fund had $5 million in assets. But they can provide some at-risk capital or things like that to the GP, co-GP. Is that kind of how you guys are structuring it?
No, what they'll do is they'll put the money into the fund, and then the fund will make a loan to Freedom Venture Investments, the mothership, if you will, and then that company can deploy capital through the management company into the various assets.
Okay, great.
Yeah.
that's
Get creative.
yeah, that's an interesting concept. Yeah, so that allows you to do that. The other thing you could do is you could do a Reg A plus offering.
Right.
Then you'd be able to
Well,
buy the end.
I've spoken to a couple of, heavy hitters over the years, and the Reg A documentation, reporting, customer service, that can be pretty challenging. So we keep the non-accredited investors to a minimum. They are people who've got pretty substantial relationship with us. They've got my cell phone number, put it that way. It's just the way I am. Look, my number one job, I'm sure you appreciate, is to be a custodian and a steward for other people's capital at the end of the day, right? So,
that's important.
We take.
You need to do.
Sure.
You need to have that mentality to be in this business. It's not about you, it's about them. It's about your investors.
Look, I bought an investor in this week. Not a huge amount of capital. It was $250,000. They came into the build that we're doing right now. And, I've worked and known this guy for a long time. He's a business owner locally. And it's funny because he said to me, he's like, Dave, I understand what this is 99%. He said, but at the end of the day, I understand 100% that I'm investing in you. And he really has it right? You got to bring that investor up the education gradient. All of us as syndicators.
Yes.
We've got to bring the investors up the education gradient. And then at the end of the day, what are they really doing? They're investing in our thesis, our investment thesis, and us as a team. So if you're not available, if you're flying around in your private jet or whatever it is you're doing, and you're not connected to your investors, look, I could be wrong. Maybe I think too small. I don't know. I got to sleep at night. And if I can't know that, there are controls in place for that capital to work with velocity, then I'm not taking the capital. I'm not interested in the business. It's just my DNA. And again, I could be wrong, Kim. I don't know. Maybe it's because I'm a blue collar kid, not straight out of university. I don't know.
So how long, okay, so we talked about kind of how you finance it up front, how you set up the acquisition with your co-GP, your LP structure, and your two-stage raise, all of that. And then we talked about the fact that you hold these properties for rent. But what is your exit strategy? Like, how long do you hold? Do you sell them off one by one? Do you hold forever? What's
Look, each property has its own business plan, obviously, depending on market, etc. What's going on. But if I gave you an average, an investor would deploy capital without any expectation of any return for 2 years.
Yep.
So a year to get through all of the entitlement, a year, 14 months to build. Now we've got 1 year to stabilize, depending on the size of the asset. And then we've got 2 or 3 years to maximize rent. And at that point, it's an exit into the market.
Okay.
And when we look at that, structure, if you will, or that business plan, the equity multiples target out to be pretty nice. I mean, they're not, 17x, but you can start looking at 3, 4x multiples. The IRRs get to be pretty substantial. And investors understand it. And it's great having an attorney on the call, because we always got to be compliant and careful. And you tell me if this is non-compliant language, but one investor said to me, dumb it down, Dave, make this really simple for me. I said, look, man, you can take your $500,000, your 250, your 100 grand, and you can go put it in a bank CD, right? A certificate of deposit, and you're not allowed to touch it for 24 months. And at the end of 24 months, you can cash out your CD at your 0 point kiss my rear end return on your money. I said, the money's gone. I said, you could maybe, if you chose to, I don't know, I'm not telling you it's the same, but you could potentially think about this investment in the sense that the capital goes in, and now don't think about anything for 2 years other than the monthly updates, any communication with us as a company. I said, and then that money comes out and starts going to work with some velocity. Right now it starts working, the cash flow, the lease up, stabilization, property management, all the things we're familiar with as syndicators. I said, and then it comes back to you with a whole bunch of friends at the end of it. I said, that's really the concept over that, 5, maybe 7-year run, depending on what the market is doing at the time of business plan disposition. So those are the expectations that our investors have.
5 to 7 years is what you said?
Yeah, I would say 5 to 7. You could dial it back to a 3 to 5, but I don't think you're doing the investors any favor at 3-4 years when you can get another, year and a half, 2 years of upside in expense decreasing expenses and increase in rents. And the other thing to take into consideration in the build for rent process is I don't have 25 years of the building being beaten up, right? So I've got a nicer asset to bring to market at that 5 to 7 year point. So
I had somebody tell me once, a developer say, well, people typically sell after 7 years because that's the point at which things start to break. You have to start maintaining if it's new construction. And so better to pass that on to the new person who wants to infuse new capital and do that than to try to recapitalize within your own syndicate. And that makes sense. So how did you learn how to do this?
How did I learn how to do this? Look, it's kind of interesting. I'd love to tell you I went to development school and graduated from Harvard with a real estate degree, but I've always been kind of in the trenches. So for me, I've learned to do this and be where we are by leveraging other people's experience. And look, I don't want to sound kitschy and seminary, Kim, I really don't. But the truth of the matter is this: I don't care who you are. If you're the smartest person in the room, you're in the wrong room. So one skill set I've developed in my own journey is to surround myself with people a lot smarter than me. So your question is, how did I learn how to do this? I had a 5-year friendship, quasi business relationship with my chief investment officer, Walter Novicki, who had been developing and building and managing and raising capital for 25 plus years. And the skill set in that one market, Fort Myers, Cape Coral, Sanibel, up into Rotunda, anywhere in that western corridor of Southwest Florida, they know my partner. So what value can I bring to that guy so he can share all of his experience with me? Well, it's my dynamic personality and my kind of celebrity status.
Bit of a celebrity.
Bit of a celebrity. I couldn't remember the language. See the way I went full circle on the conversation? So look, I've been able to glean and learn hands-on the process of this development stuff. And look, it's not wholesaling a single family home. There's not a home study course for $1,500 that's going to get you through this process, right? Whether you go learn it in a collegiate environment, you need capital on hand to do this, to get through development, acquisition, understanding the pitfalls, your 21Es, all of the challenges that we have, and then having the right legal team to make sure your documentation is solid. It really is that team concept, right? Everything that you do at the Syndicators there, it's all of that is unbelievably valuable, because you can go out with good intent, but it's just like anything else. Your good intent doesn't keep you out of court if you don't know what you're doing, right? So when we start taking millions of dollars of other people's money in, you damn well better know what you're doing, period. And that's not YouTube University, right? It's application. It's knowing what's going on at any time. So I learned from people around me.
I want to let everybody know that we are going to go to live Q&A in a couple of minutes. So some people have been putting stuff in the chat. I'll check that out. But also you can click the Q&A button if you want to ask some questions there, or there's a way for you to raise your hand so we can look for people that have their hand raised as well. So if you have any questions for Dave or me, he's far more interesting than I am. I would suggest you ask him his questions, because you can get access to me in other ways. And, let's pick his brain while he's here. I think he's got some really valuable lessons for us. One thing I would respond is I know the CCIM courses for real estate brokers do go into development. I think there's another organization called NAIOP, NAIOP or something like that, that I believe also has some development style courses. None of these courses are cheap, and of course they take time, but there are some opportunities that you can learn this information if you want to. But I did the same thing you did when I started out as a securities attorney. I had a mentor. I worked with him for 8 years, and we built a business together, and then kind of went our separate ways. But leverage is, I had instant credibility because of who I associated with. And so if you're
Sure.
just starting out and you've never done this before, then you need to go where builders and developers go, and try to become part of their team, and work for them, offer services, bring them investors, whatever you can do to add value to what they're doing, that they're willing to then share their knowledge with you. And a whole lot of people that attain some status in their professions really want to pass it on. And so if you
That's the truth.
find people in the right, in the right way, and you can offer them something so that you're not a burden to them, you're actually adding value. I actually have a client that, went to work for a developer fresh out of school and fresh out of college, and has worked his way up into being the secondhand guy in probably 5 or 6 years with this developer, just because the other developer is like, hey, I'm 68 years old, I want to retire. So
Yeah.
you can get in with people like that are looking into their future, and figure out how you can kind of leverage off their experience and help them in the process. So I always think about, how can I help you, for your investors and for other people that you might be working with as your mentor. All right. So anything that you think we should talk about that we haven't covered yet, Dave?
No, I'm good. I'm an open book. I like Q&A. There's no area that we can address, put it that way.
Okay. So just before we go to Q&A, in case some people have to drop off, is there a way that people could reach you, or do you have a website or something they can go to just to learn more about your organization, whether they want to invest with you?
Yeah, absolutely. Look, I'm old school. You can actually pick up the phone and get a hold of me via a telephone. It's a thing that you punch numbers in and people answer them on the other end. So the phone number for the company is 781-922-4418. If you do reach out and want to have a conversation, make sure you let me know that you heard us here on this particular podcast. If you're newer to syndication, if you're newer to investing, if you're newer to development, reach out to info@freedomventure.com. You can also go to our website, freedomventure.com. There's a bunch of resources. There's a free download on there somewhere for what is a good diversified portfolio between stocks and bonds and real estate. Or just Google my name, Dave Seymour. I got rid of all of my past arrest records, so it's clean now. You can, that's not true. The SEC won't let me do what I'm doing.
Okay.
But seriously, you can Google my name, Dave Seymour, Seymour, and I'm sure you can find a way of getting a hold of us.
Okay, so I put all those contacts in the chat. And if any of you don't know how to save the chat, you can do that. There's 3 little dots just to the right of where you would actually type a message. If you click those dots, you're going to pop up in one of those, going to say save the chat. So, all right, well, let's see. I'm going to scan the chat right now and see what people were saying. All right, so SAG says, how to decide if the land price is expensive or cheap for construction?
Yeah, great question. So look, everybody's concerned with construction costs right now. They're concerned with supply chain, et cetera. Your underwriting and your pro forma needs to be stress tested. Just because it's 15 grand a door doesn't mean that it's a good deal if the market, once you run your rents and your expenses and your building costs and everything else through your underwriting pro formas, you might want to be at 10 grand a door, or 15 grand a door is a steal. I and I don't mean to take it at such a high level, but you have to, because there's so much involved in a good underwritten pro forma. But it's basically income and expense ratios. Do they make sense? Management costs, expense costs, annual expense increases, annual rent increases, and then getting through your project with what's called a GMP. GMP is your gross maximum price construction contract. And, being able to get a competent GC to put that GMP together. I'm going to be honest with you, it takes a lot of work. It's not something that happens overnight. We use a national GC that comes into our markets and builds out that team to execute on the build. So it's a case of
GC is a general contractor.
Yeah, GC is your general contractor. We use a national contractor because they have massive buying power. They don't go to the Home Depot or Slows to buy 2x4s, right? They're buying them on bulk. They buy their steel on bulk. They can, store that product, if you will, and pull it down as they need it. So, to answer your question succinctly, which isn't always my my strength, work from the back to the front, right? What is your income at the end of 5 years? What does that look like? And then work your expense all the way to land. Make sure that you've got good numbers for your entitlement. Make sure you've got good engineering numbers. Make sure you've got good architectural. I mean, I'm into architectural plans on the 106 unit build, probably around $250,000 right now. So, this isn't buy, fix and flip, 1,500 square foot house. It's a different game. I hope that answers your question.
No, that's absolutely right. And I even with a lot of my value add clients, they come to me and they don't understand that you've got to do you have to know what the likely sources and uses of funds are for your project, which means you've got to calculate out what is the total in cost, what is going to be my construction cost, position fee, my closing costs, what's going to give me some money for working capital and reserves, what might the bank require as some impounds for insurance and taxes, those kinds of things. You've got to factor all that stuff into your uses of funds, and then the sources of funds has to equal that, right? Because if there's a disparity there, the project done. Then you have to do your operating pro forma. So in a development project, you're not going to have any income for a couple of years, but you're going to have a whole lot of expenses. But at some point you are going to have rentable units and you're going to start getting some income and you're going to start having the customary expenses. So in a value add, you just, work those numbers in from the beginning. You would have income and expenses, and hopefully those, the income would be increasing, and, hopefully the expenses would be increasing at a slower rate, but not always the case. And then you have to go, what is my exit strategy? What is my proposed exit strategy? So you're trying to figure out cash on cash return at all during the year by year pro forma, and also at the exit strategy. What is my overall cash on cash return? And add together what came from cash flow plus the equity that you get from the sale, divide that all up over however long you've had everybody's money, and that gives you your annualized return. Once you know that overall annualized return, now you can figure out, all right, how much of that do I have to give to investors? What percentage of that do I give to investors in order to get them the return that I want them to have, or that's going to entice them to invest with me? And how much of it do I get to keep? And is it worth it to do the deal? Because if there's nothing left for you, you don't do the deal. And I have people come to me and it's like, well, I've got this deal and I can buy into it, and I'm going to get a 7% return every year, and and I want to get investors. It's like, you can't. You can put your own money in that deal if you want a 7% return, but you can't. There's nothing for you. It's just not a viable syndicatable deal. So you've got to figure all that out, and that's when you now are ready to start showing your deal to investors and getting your legal documents prepared, because until you have gone through that exercise and learned those numbers, you don't even know if the deal makes sense, and what you should even talk about it. So okay. All right, so Brandon asks, said, would love to hear about the fee structure, especially in this co-GP phase.
Yeah, great question. So the co-GP gets to participate in the fees, cash flow, and disposition. Okay. Industry standard 1% to 2% acquisition fee. at the time of closing. And then the development fee is the capital that we use as GPs to pay ourselves to keep the project moving. There's a lot of investors, and that's 5%, 5% of the overall project cost. You know, there are some investors out there that start looking at GP fees and they start to beat them up. I'm going to say this loud. I'm going to say it clear. Do not try and nickel and dime your GP. They are the most underpaid, right, capital employee that you will ever have for your potential return profile. So that's pretty much the fee structure. Then the waterfall structures at time of cash flow. We have generally preferred up to 8% for our LPs. Once we're over 8%, we'll get into a 70-30. So 30% to the GP or co-GP, because that's what they are at that point. They get to participate in that. Once we get to maybe a 12% return, we might up it up to 60-40. If we get up to 16%, we might do a 50-50. So, you know, without sounding like a Fisher commercial, you know, the better we do, the better our GPs or co-GPs and LPs do. You know, it's a true statement in this environment. So acquisition fee participation, development fee participation, cash flow participation, and then disposition profit participation is where the co-GPs get to come in and play. But again, remember, they're in the
disposition waterfall is going to be back capital, pay, makeup, pref, and then go through your split structure. Yeah,
correct. But remember, again, that they're in a higher risk, you know, profile because they're first in. So, you know, some people understand it. I want to participate anyway. I've got one investor that loves coming in early, and he'll write pretty substantial checks to do that. So, you know.
So you would do your co-GP, you get paid first, get paid back their money first and their pref first before you get into the other class?
No, nobody's getting paid back first. No, they participate all the way through the full cycle of the investment.
But you do have a subclasses or multiple classes within your investor class. You have the one for the co-GPs, and you have a second one that came in later, right? So in that pari passu structure, your co-GPs are getting their capital back first, or does everybody get capital back pro rata? And
everybody gets principal back at the time of disposition.
Okay. Principal back first.
It's just that the co-GP capital is working at a higher rate of return than the LP capital.
Okay. And so everybody still gets paid back kind of pro rata, but they just get a higher return.
Correct.
Okay. That's an interesting structure. You guys don't do any kind of class B catch-ups, huh?
No.
Or your management catch-up, because you've got this tiered structure with your splits.
Correct.
That's correct for that, and that works out well.
We look at the deals. I want to take down a deal without, you know, puffing up any numbers. I want to take down a deal where I can, in confidence, offer a 4x to my co-GPs, and I want to be anywhere between a 2.5 and a 3.2 for my LPs. If I can, with integrity, plug all those numbers in, I like that deal structure. It's exciting for my co-GPs. It's also exciting for my LPs to potentially meet those kind of return profiles. So that's part of the underwriting for us, to be able to structure these out so that people feel good about coming into the deal with us.
Great. Okay. Good questions, you guys. Art says, yes, it's very important that you protect your investors' capital. Calvin says, hey, really enjoying learning about this stuff. Thanks, Calvin. Stoney says, do you have any interest in any Florida markets beyond Cape Coral?
If the supply and demand is there, yeah. I mean, I did a small deal in West Palm Beach on the other side of the state. We held that property for 9 months and brought it back onto market. So that was an existing structure. That wasn't a build for rent structure. The answer to that is yes. I can deploy teams anywhere in Florida with pretty rapidly.
Okay.
But again, supply and demand, they got to meet the underlying requirements for it to make sense.
Brandon asks, is there a way to JV with Dave in the Seattle market?
No.
And that goes back to that earlier question that we don't want to touch.
Yeah. Yeah. And I don't mean any offense, but look, if you ever get an email from me, my email tag says a yes or a no is more valuable than a maybe. Yeah. Right. I'm not going to be the guy who goes, yeah, maybe I will. No, I'm not doing business in Massachusetts where I live. I'm not doing business in New York. I'm not doing business in Seattle. I'm just not. It doesn't excite me. And no disrespects to anybody who's in those markets. It's just, I don't have to. Right. So.
Yeah, there are other more business friendly markets. Okay, so Art says, it's been suggested that the GC becomes an investor in the project to keep them moving forward all the way to the end. Well, I guess that's the structure that you're really using because, the general contractor. Well, I have mixed feelings about that. Okay, so if your general contractor is a partner and they don't do their job, you can't fire them. I don't know. What do you think about that?
That's a great answer. That's a great answer. Look, I'm with you. I'm with you on that. You said something earlier in this conversation that was pretty poignant. Was, I've worked as an attorney and I get to see my clients' checks, and I want to move over to the other side of the equation and still keep my attorney skills, right?
Right.
Well, it's the same for the general contractors. They're not stupid, right? It's not like, they know where the money is. And at some point or another, we used to say back in the day in the single family business, a good GC is only good for maybe 5 deals. And then they're like, they want to raise their prices, et cetera, et cetera, et cetera. I think for me, because I've dug ditches, I've been on the other side of the equation. I think for me, you let them perform. Show me why you should be a partner in the next deal. Show me how fast you can get through without, putting crappy work in the marketplace. Show me how flexible you are on change orders. Show me how flexible you are on process. Are you a team player, or are you that egotistical general contractor that thinks they know everything? And if you're a team player and you perform well, let's have that discussion. Let's have that discussion, but you're going to bring some equity to the table as well. You're not just coming in.
That's where I was going to go. I was going to say,
there you go. All right. You thought I was going to leave that out, huh? No, you bring some money, you put skin in the game.
If they're not bringing money and all they're doing is their job, then just pay them to do their job. And I mean, that's true of anybody, a real estate broker, insurance agent, mortgage broker, any of those people. If they're not bringing something else to the table, they're not helping co-sign the loan, they're not helping bring money to the deal, something besides their actual job, then don't bring them in as a partner into your deal, because you end up paying them 10 times more to do their job. And then they know it's kind of a guaranteed payment. They don't have to perform to get paid. So you're kind of stabbing yourself in the foot. And I'm sorry, Art, because Art is a general contractor, I believe. And
that's all right. I was too, brother. No, I'm with you, man. No, I was as well. I was as well. Look, everybody has to show their value. Yeah. Everybody, the attorney, the engineer, the contractor, the operator, even the LPs, they got to show their value, right? A yes or a no is more valuable than a maybe. So if value is shown and proven, then compensate it well. Pay early, pay often, and then people appreciate that. So that's how I look at it.
All right, we'll see if we can get through 1 or 2 more questions before we have to go. I think I know the answer to this one. Do you only invest in build to rent, or do you also invest in existing multifamily?
No, both. We're yield hunters. I'm a GP. I have one job, is to hunt yield. And when all of these compressed market acquisitions come back around in the next 12 to 18 months, he or she who is most capitalized will win this game. So we're ready. We're bringing in substantial capital now to be able to take down existing structures and reposition.
Yeah. Okay, so here's a question. I think we know the answer to this one too. And I don't even think we have to answer it, but I'll ask the question. What do you feel about the New Jersey market? Okay, so we mentioned something before about business-friendly markets. I don't think New Jersey qualifies for that. So I think we can just move on with that. So, sorry if you live in New Jersey. Hey, I used to live in California, and my answer finally was to move. And I have clients that still live in California. And whenever they say, well, how do I do this in California? I say, you don't, you have to move. It's just the
I'm
way
with
it
you.
is. That's just the way it is. I think, somebody asked, what's your business track or your sponsor track record? Well, you just have to talk to Dave personally about that, or look at his website if you want to see that stuff. All right. Well, Dave, this has been amazing. I've learned a ton. I have taken a zillion notes. I hope everybody else has too. We will certainly post this on our website. We will also transcribe it. You'll probably see snippets about it on YouTube. That's one of the ways that we maximize these events so that we can reach out to the largest audience and try to educate them. If you want more information about Dave, look in the chat. Let's see his number. I'm going to see if I can find it again. Dave, go ahead and just tell us your phone number. Let's see, we've got
the number to, you can 781-922-4418,
okay.
freedomventure.com. If you
Okay.
want to shoot us an email, info@freedomventure.com. If you want to look at our offerings, we can talk. If you want to learn some stuff, the website's got fantastic resources on there. So now it's in your court, whoever you may be. You got to put the effort in. We did our part.
That's right. And if you want to reach us, it's syndicationattorneys.com. If you'd like to schedule an appointment, there's options there to schedule a free appointment with one of our staff, or if you want to schedule a pay to consult with me, you can do that at our website. Just click that button, schedule an appointment, and we'll be happy to talk to you. We also have some low cost options for you to become clients of the firms. We have a pre-syndication retainer that's for people that don't have deals yet but want to have continued access to us. And we do masterminds so that you're able to weekly connect with one of our attorneys, either me or another one of our attorneys. So anyway, thank you everybody for showing up today. This was very lively and very fun. Dave, had a good time, and hope to have you back on the show again soon. All right, thank you.
Take care. Talk soon. Bye-bye.